There we go. Great. So there are quite a few changes in the tax law that are going to have pretty substantial impacts on your customers or on your taxpayers this year. We're going to go over the most impactful things. Are there other tax law changes that we're not going to go over? Absolutely. There's a million tax law changes every year, but I'm going to cover the things that you guys are going to see the most often. So that's where we start here. So we're going to start with changes to child tax credit, changes to the child and dependent care credit, earned income credit changes, the 1099K, which has been all of the talk all over social media all year. Some other annual changes, increases to standard deductions, things like that. And then a couple of other tax law changes or reminders. Starting with child tax credit and the advanced child tax credit. So last year, as part of the American Rescue Act, I think is what they called it, child tax credit got a massive overhaul. The amounts went up, the eligibility requirements went down, it was fully refundable. All of those things applied for a single year. Everything is going back to the way it was from 2020 prior, if you will. It's reverting back to pre-2021 rules. So child tax credit is going back to the partially refundable form. Last year, it was fully refundable. The credit amount drops back to the $2,000 per child. It was $3,000 for children 6 to 17 years of age and $3,600 for children under 5 last year. The eligibility is also changed slightly. The eligible children are those under age 17 now. Last year, they had raised that to 18. So when we say under 17, we mean 16 and under. If they are 17, they no longer qualify. And then thankfully, there were no monthly advance payments, so we don't have to reconcile anything like we had to do last year. So for those of you who've been doing this for a while, we go back to ignoring the 8812 like we always have. That's pretty much the gist of it. This is going to be the bigger sticker shock, I think, for most taxpayers, and that is the child and dependent care credit goes back to what it was pre-2021. So for tax year 2022, the amount of qualifying child care expenses was decreased. The max last year was $8,000 for one child and $16,000 for two children. The max this year is $3,000 and $6,000. And what that means is that's the qualifying expenses. So the cap on the amount of expenses that can be claimed on Form 2441, which is the child and dependent care credit form. The maximum credit went from $4,000 to $1,050 and $8,000 down to $2,100. Now, keep in mind that this last year, the child and dependent care credit was fully refundable, which means everyone got it. This year, it is a non-refundable credit. So the difference between a refundable credit and a non-refundable credit is where the money goes, basically. Refundable credits, or let me start differently. Non-refundable credits can only be used to reduce their tax to zero. Once their tax reaches zero, they get no more credit. So if they only have $200 in taxes and their maximum credit on the dependent care is $1,050, they get $200 off their taxes. That's it. I liken it to a coupon code, right? If you go and buy something at a store, they take it down. If it goes more than zero, they don't give you money back. That's not generally how it works. That's how a non-refundable credit works. Refundable credit will take you down, your tax down to zero, and then pay you out the remaining balance. So if they were getting $2,000, for example, in child tax credit, and they had $200 in taxes, they would take it down to zero and then give them the remaining balance. And in that particular case, child tax credit wouldn't give them the full $1,800, they'd give them the refundable piece, but that's splitting hairs. Now, the income limits and the credit rate are back to the pre-2021 form. So means the credit, they get 50% of the expenses paid when the AGI is under 15,000. which really means they don't even really get 50, they get 30. Last year it was up to 125,000 that was getting the max credit, if you will. That credit gradually then declines until it reaches 20% when the AGI reaches 43,000. Last year that had been raised to 183,000. The 20% rate for all AGIs over 43,000. There is no phase out. Last year the phase out was at 438,000. So these are going to be substantial changes for some of your customers who had child independent care credit, and they are not going to understand why. They are likely to get heated about it, and I hate to say it in sort of this context, but the only person they can talk to about it is their congressman, because this is the bill that they negotiated. It is what it is. It's just going back the way it was.
Kevin, before you move forward, is something I want to do a little bit different. I would like to ask the questions before we move to the next slide, so that way we don't have to go all the way back to the beginning if people have questions on something you said. So I would like to open the floor now. If anybody have a question, go ahead and unmute yourself. If you have any question to this slide or the one before, there's something you didn't understand, speak now. Okay, I guess we're good. Okay. Okay, Kevin, thank you.
No problem. Hang on one second. I want to move some stuff around over here. You can also throw any questions you have in the chat, and I will answer them as I see them. So moving forward, a couple of slight changes to earned income credit. The disqualified investment income, that maximum amount is increased to 10,300. And then for those people who were qualifying with no children, there were some changes to that last year, and you may have some people that this affects this year. They raised the minimum, or they lowered the minimum age to 19 last year. The minimum age is back to 25. The maximum age is 65. Last year, they eliminated that. So you did have some people that were over 65 that were qualifying for earned income credit based on their income alone that are not going to qualify this year. The maximum credit is down, if you will, to 560, and then the credit is fully phased out at around 16,480, 22,610 for married filing joint. So do we have any questions about those two slight modifications for earned income credit? Perfect. This is the slide everybody loves. It's the EITC max credit for tax year 2022. So as you can see, we've got some columns here. The first column is the number of children. The second one is the max credit. Then the last two are the max AGIs. The max AGIs will tell you the max AGIs will tell you where they cap out. Sorry. That second column is the column that you guys love. It's often used for marketing. Just be careful when you put any kind of marketing out there that you use the words up to. In that marketing, that'll keep you compliant with the IRS. You can't tell someone, even in marketing, exactly what their refund is going to get, or that everyone qualifies for this credit, because that's just not true. Right? Everyone is not going to get the maximum amount. Everyone is not going to get not everyone is not even going to qualify for this credit. There are going to be people who don't. We give you guys the AGIs in particular so that you save yourself from having to make a call to support about why credit isn't calculating primarily, right? You'll know looking at these AGIs that if you have a single person who has 3 or more children, but they made $75,000, they're not going to qualify for EIC, right? If they're married, same amount. The cap line for you guys to just remember quickly is no matter how many dependents they have, if they're over $59,000, they're not going to get it. If you know that will save you a lot of headache in trying to figure out why this person doesn't qualify for EIC, maybe when they did last year. Income is the number one reason. Filing status is another reason. Married filing separate, for example, doesn't qualify for EIC.
and then the investment income. So keep those things in mind on that. So before I get into the 1099K, does anybody have any questions about anything we've done so far?
I think, Kevin, especially for I know a lot of people have some new employees that are, this is all new to them. One of the way that I explain this so people could understand, again, because of that question, you said people will call and say, hey, how come they're not getting, I have somebody with 2 kids, how come they're not getting $6,164? So I always tell them that's, you got to explain to client they qualify to get up to that much. That doesn't mean they get that. And if they have 2 kids, if they make too little bit, which is one of the questions we get asked the most, somebody got 3,000, made $3,000, and they expect to get the 6,000. And I explain to them that even if they make less than the qualifying amount, they don't qualify for that as well. So just keep
Mhm.
that in mind when you're doing a tax return and you get a client, let's just say with one person, with one dependent. If you get a client that has one dependent and they made $3,000, they're not going to get that 3,733. What I've noticed from the numbers is in order for that client to get close to getting the max, if they have one dependent, they got to make around 10, 12, around that's like kind of the window um, for you to get the max. Once they go over 12 is when you start seeing the phase out. If you go under 9 is when you also see, phasing out as well. So just keep those windows in mind. If they have 2 kids, it's 12 and 14, and 3 kids, it's like 14, 17, like that you're going to be able to see that they're getting very close to the max amount, right? In those windows. And with you knowing that, you'll know that if that person not getting not even close to the amount, either they made too little bit or they're making too much. Like,
Yeah, EIC is what they call a bell curve credit, meaning the lower your income, the lower your credit, the higher your income, the lower your credit. So it goes in that sort of shape, like the hump on a camel, right? There's a base, there's a low point on both sides, and where your customer needs to be to get the maximum credit is in the middle, not too high income, not too low income.
mm,
There's a nice little sweet spot that's in there. I would encourage you, if you haven't done this already, go to the IRS and or Google and search for the table. There's a table that breaks down every dollar amount of what the credit should be. Um, it's available on the IRS website. I don't know if this year's has been added yet, but uh, if it hasn't yet, it will be soon, I would imagine. So keep that in mind as well. All right, the 1099K. So this was going to be a big problem, and then the IRS announced that they are going to delay the reporting thresholds for third-party settlement organizations. So I'll kind of touch on what they were being told they were going to have to do, and then how the IRS came back at the end of December and said, no, we're not going to do this. The third-party settlement organizations, what they mean by that is companies like PayPal, Cash App, Zelle, Venmo. Those are sort of the four big ones. The threshold for them to issue 1099K forms was lowered to $600, regardless of the number of transactions. Meaning, if they had $600 or more in what would be deemed as business transactions, not transfers between friends or family, but business transactions, then they would be issuing 1099Ks. That was going to present a bit of a problem because a lot of these third-party settlement organizations had no way of knowing how to classify these transactions for most people. Some it was pretty easy, for others it was going to be very difficult. As a result, the IRS got tons of pressure from tax organizations, from these third-party settlement companies, because I can tell you, I talked to a developer friend of mine who was working at Venmo in November, I think, and they still had no idea what they were going to do.
So they couldn't figure out how to track this properly, and so the answer for them was going to be we're issuing 1099Ks to everyone who moved more than $600. That was going to be a nightmare for us on the tax end trying to reconcile all this stuff for people who don't actually have businesses. So thankfully, we are not going to have to worry about that if they get a 1099K this year. It's because they earned it, not because of some crazy lower threshold amount. So before we jump into annual tax changes again, at any point, if you guys have any questions,
I do. I have a question.
go right ahead.
Let's say that, okay, I'm a little bit confused about the 1099s. A company needs to give an employee. What if they paid that employee through Venmo? I mean, the Venmo is going to be for, I'm going to say me as an employer?
Technically, yes. I mean,
Okay.
that's what they're looking at. But like I said, thankfully for this year, it's not something we're going to have to worry about, or we shouldn't have to worry about it, because that filing threshold has been raised back to the 20,000. Somebody's moving 20 grand around Venmo. Yeah, I mean, that's likely a business transaction. I mean, I don't have a lot of friends that are pushing 20 grand and 2,000 individual transactions, because that's where the benchmark line is.
Yeah.
According to what the IRS had told these companies in previous years, it was $20,000 and more than 200 transactions or 600 transactions, something like that. You're running that many transactions in a year. Yeah, I mean, that's going to be a business. I don't know anybody who's slinging around that kind of cash on Venmo. And sort of the question that you're asking is part of the issue. Would the employer they get a 1099K for that because or would the employee get a 1099K for that? And the answer is,
I still need to give the employee should still get the 1099.
They're still going to get their 1099 NEC regardless, either way. Yeah, I mean, if the employer pays an employee, and in this case, not an employee, but a contractor, then they still have to pay them. They still have to report that income in the same, in the same capacity. That part didn't change. It's just sort of tracking these kinds of transactions. That's what they were proposing, and thankfully, someone came to their senses at the last hour. So moving on to a couple of just small changes to annual changes. This is the tax brackets for tax year 2022. There's nothing. I mean, the tax rates didn't change. We still have the same 7 tax brackets we've had, or 8 tax brackets, whatever it is now. 7. Same 7 tax brackets we've had. Just the amounts have slightly increased. Same thing with the standard deduction. The amounts have slightly increased. This is a pretty standard thing. It increases pretty much every year. There's one thing here that I want to point out, and that's because I didn't know, and I learned something this year in a discussion with a friend of mine who works at the IRS. And that's right here on married filing separately, where I have that asterisk, and then it goes over to the other side. So for someone that files separately, right, if one spouse itemizes their deductions, then the other spouse is forced to itemize their deductions. What's interesting, though, is if the second spouse does not have anything to itemize, all of their income over $5 is taxable. That was something I was not aware of. So I found that to be incredibly interesting. Are we going to see this on anybody's return? Probably not. But you learn something new every year, even after 20 years. And so when I learn something new, I like to share it with you guys.
Hey, Kevin, I'm so sorry.
No, go ahead.
Anna, can you go back to that slide? Because I want to be able to really understand what it is that you're saying here, but in English. So can you just kind of go over that little asterisk again? So if I'm married, right, and let's say my husband has a business, and he itemizes, right? How does that then impact me if I'm like, I don't know, I work part-time or something? Can you just kind of give me an example of what that would look like in real life?
Sure. And what we're talking about here specifically is anybody who's married filing separately,
Okay,
right? So if they're filing separately and the first spouse itemizes their deductions, then
Sure.
by law, the second spouse must do the same thing. But if that second spouse doesn't have anything to itemize, they don't have medical expenses, they're not
Right.
paying mortgage insurance premiums,
Mhm.
then technically by law, all of their income over $5 is taxable, meaning they get no deduction. They don't get a standard deduction, and they don't get an itemized deduction. They get no deduction if they have nothing to itemize. Here's
Mhm.
the truth. It is very difficult for that to ever happen to someone because of state and local taxes.
Okay.
Because you can always itemize state and local taxes. Even
Okay.
if you have nothing else, you have state and local taxes in most cases, right?
Mhm.
Especially in Texas, we have sales tax. You can always write off sales tax. So the chances if you guys ever running into this scenario are
Mhm.
1 in a million, probably.
Okay,
I just thought it was interesting, and so I wanted to share it.
okay, thank
I
you.
have a quick question about that.
Sure.
What have you run into a scenario, and maybe you haven't because we're just discovering this, but what if they don't know if their spouse itemized or not and maybe can't find that out?
The IRS will tell them when they file their return.
Gotcha.
They'll
Okay.
reject it saying, that they must itemize. And a lot of times it's who gets there first, because the opposite is also true, right? If one spouse claims the standard deduction, for example, the other spouse has to claim the standard deduction whether they can itemize or not. So though the spouses have to have to claim the same deduction, whether it's an itemized deduction or a standard deduction. They have to claim the same one. They don't get they don't get to have two different ones based on what they want to do. They must match. And I think if I remember right, the rejection says something to the effect of deduction mismatch, I think is what it says, but it'll explain it in the software if you run into that. I've only seen that a handful of times where that scenario has happened. It's not common, and quite honestly, you're going to have a really, really good reason to file separately in Texas because it's community property state, which means legally everything is split 50-50. That includes the debt and that includes the income. So there are some reasons to do it. Most people do it because of injured spouse, and because one spouse has back taxes or one spouse owes child support, and there are other remedies besides filing separately for that.
Kevin, just like you gave the example earlier, the difference between refundable and non-refundable credit, can you give an example for itemized deduction in my mind went blank.
Standard.
Itemized and standard.
Yeah, that's a tough.
Return that is filed with itemized deduction, which, like you said, it will be a Schedule A, right? Itemized deduction is when you file expenses in Schedule A.
Right.
And standard will be Schedule C.
Now, standard is a flat amount that applies to everyone who doesn't itemize their deductions. That's really what it is. This is a flat amount across the board, right? Every person who is single has the right and ability to claim to have the first $12,950 of their taxes not taxed, right? They can deduct that amount from their total, regardless of anything else. Itemized is if you have expenses, for example, mortgage interest, charitable contributions, medical expenses that qualify, that exceed the standard deduction amount, then you would be in a better tax position to itemize your deductions. I will tell you this, the number of itemized deductions has gone down drastically because of the 2017 Tax Cuts and Jobs Act, when the standard deduction basically got doubled. When that went up so high, that lowered the number of people who had expenses to clear this. So you're going to see a lot more standard deduction filers than itemized, but knowing what that standard deduction amount will help you guys as you're preparing that tax return. Because when they bring you and they go, well, I have all these expenses, and you look at medical insurance, mortgage, those kinds of things, you can run a quick math in your head, get a rough estimate, and if they're nowhere near 12,950 as a single person or 19,400 as head of household, you don't have to waste your time filling out that Schedule A. I run into that every year. I do my brother's taxes, and every year he's like, "Do I need to send you my mortgage stuff?" No, because you're not coming anywhere near it. Like, I don't need it. I don't want it. I'm not filling out a Schedule A for you because it's not going to attach to the return anyway. Because the software is intuitive enough to say, hey, your itemized deductions are not greater than the standard deduction. The standard deduction is better. You can force it if you really want to, but I wouldn't recommend it.
Have you ever, I don't know if anybody else have run into this. I saw where a client was trying to file all the prior year taxes and going back 3 years. And one of the years, you know how you call the IRS to find out everything that was reported for them that they need to file on their taxes. Well, for 1 year, the only thing that was reported for that person was their mortgage. And the IRS says, well, you got to file your taxes to file your mortgage. I'm like, but there's no income or any, do they still need to file their taxes? And they wanted them to file their taxes and just report their mortgage, even though they didn't have nothing else but that.
Yep.
Have you run into that?
The IRS wants them to file their taxes. And so they will tell you that repeatedly.
Oh,
You need to file, you need to file. And the truth is, you probably should. There's really not a lot of reason not to. Even if you don't have anything necessarily to claim, filing that return doesn't hurt you. It's not going to, it just takes a little bit of time. And that's really the end of it. Now, those people who have that, in that scenario, file it. You can always add $1 of other income. I promise you, someone gave them $1 for something at some point in the year, right? And $1 in other income will clear the software and let you go through, or $1 in the wages field. It doesn't matter. They're not going to get taxed on that $1 anyway. So, technically speaking, this is just how crazy our tax code is, right? If you, for example, we have a dog sitter. She's a neighborhood kid. She comes and watches this dog, when we go out of town or whatever, when we pay her a couple $100. Technically, she's supposed to report that because the IRS wants their cut. Do I pay her more than $600 a year? No, because I don't travel that much. She gets, I don't know, maybe $200 a year. Technically, she's supposed to report that. Even though she's not going to be taxed on it by law, she is supposed to report that income. So the IRS, if she asked, the IRS would tell her you need to file a tax return because that is their stance on everything. So yeah, I wouldn't worry too much about those, honestly.
Yeah, but my question is, because back to what you have mentioned, how when you do your brother's taxes, if you already know that he doesn't need to report the mortgage, you don't encourage him to send it to you to put it in the tax return. So with the scenario that I had before, shouldn't we encourage our client to regardless send us that form and put it in their taxes so it don't be a problem where later on, IRS, you never know with them.
No, because it's not going to attach to the return anyway. So even if you put it in,
Okay.
if it doesn't clear the standard deduction amount, unless you force the itemized deductions, it's not going to attach to the return. That Schedule A won't be in the filing record at all when it sends. In fact, just like and we'll talk about this when we get into the software, right? But everything that's on the left side of the software is what's attached to the return. If it's not there, it's not attached.
I see.
And it's not being reported anywhere to the 1040. There was 1 year though, and that may be the year that they're telling him to do it.
Okay.
There was 1 year where they were doing I'm trying to remember exactly where it was. It was on one of the schedules for the 1040 where you could report, I don't remember if it was interest points or the premium insurance, but you could report it directly to the 1040 even if you were taking the standard deduction. And then they very quickly did away with that. It was only there for one season, I think, and I don't remember what year that was. So it may be that year, and that's what they're saying. Hey, you can report it still. But they're going to tell them to file a tax return every time, regardless, even if there's nothing to report. That's just the way the IRS works.
Okay. Anyone else has questions? Okay.
Okay, so a couple of other expired deductions and credit. One is the recovery rebate credit. Yay. No more asking people, did you get the stimulus, and them going no. And then they actually did get it. It holds up the refund and all of that craziness that was going on in 2021 and 2022 for that matter. The above the line charitable cash contribution, this was something they added in one of the COVID relief acts. It allowed taxpayers who were claiming the standard deduction to take a charitable charitable cash contribution deduction of up to, I think it was like $300. That's gone. The 60% AGI limit on deductions for cash donations for on the Schedule A, and really what they're talking about is like charitable cash contributions. That 60% AGI limit is removed. There is no limit. They can claim as much as they want on that Schedule A now. And then I am shocked to finally admit that I was wrong. The mortgage insurance premium deduction as of today is still gone. I am inclined to believe this is because we do not have, everybody was worried about trying to get a Speaker of the House. And didn't get back to this. This is one of those deductions that goes away every year and then comes back at the end of December. So I was very surprised to see that the mortgage insurance premium deduction is gone. This further devalues the Schedule A, by the way, because the mortgage insurance premium was being reported to the Schedule A to itemized deductions. And so now that that is gone, that means that the amounts that people have on that Schedule A are going to go down because they cannot report this like they had in prior years. Oh. The last remaining remnants of COVID tax legislation, I should say, is the 8915F. So for those of you that don't know, I want to kind of explain this a little bit. So in 2020, taxpayers were given the option of making a withdrawal from their retirement account if it was related to COVID. They needed the money, they could go and get it out of their 401k, their IRA, whatever the case was. In those instances, the withdrawal was not subject to any penalty, and they could elect to have the amount that they took out taxed over 3 years. So let's say in 2020, they went to their 401k and they took out $30,000. They would not be taxed. They would not serve a penalty or pay a penalty for an early withdrawal on that $30,000 from their retirement account. And they could elect to have the taxed amount spread over 3 years. So $10,000 in 2020, $10,000 in 2021, and $10,000 in 2022. They would pay the taxes on that instead of paying $30,000 or having all $30,000 taxed in a single year, which is generally what would happen. So in 2020, we used Form 8915E to begin the process and tax the first third. In 2021 and 2022, on the 2020 tax return, we used the 8915E. On the tax year 21 return and tax year 2022, which is going to be this coming year, the tax returns you're doing this year, you're going to use Form 8915F. It's pretty simple. You just have to go in and put the amounts that you need onto the 8915F. For those of you that did an 8915F for your taxpayer last year, you're going to do the exact same thing you did last year, this year. And this will be the last year of it, thankfully. So this is the last remaining bit of COVID relief tax law. So, and that is it on the tax law side. Does anybody have any further questions? Anything else that you guys want to discuss?
I have a quick question, Kevin. This is Joanna again. For this last subject that we talked about, the 8915F, taxpayers also had the choice that, you know, if it was 3 years, but if they wanted to pay it all at the end of the 3 years, there was still going to be no penalty, correct?
If they paid it all back, yes.
Okay, okay, okay. It wasn't mandatory. What I'm saying is it wasn't mandatory to pay out every year a little bit of whatever taxes they were, or
No, they could have done it all in the first year.
they could have, okay.
Yeah.
But if they didn't, they have up until now in 2022 to pay it all back then in 2022 through Form 8915, correct?
And well,
Okay.
I want to clarify just a little.
Okay,
They did have the option to return the money, if you will, to
Okay.
their 401k, and then the tax would go back to them if they did pay any tax. At least that was my understanding.
okay,
So if they had paid, let's just say if they had paid taxes on it in 2020 and 2021, and then they paid it all back, then they could they would get the tax that they paid back on, you know, in their 2022 return rather.
Mhm.
I'll be honest, I don't know that you're probably going to have a lot of people that did that. 2020 was tough, and if you were pulling money
Right.
out of your 401k, you probably weren't in a position to pay
Correct.
it back.
Right.
I haven't seen that yet on any return that anybody's called me about in the last 2 years. But you're right. It is possible that they could have paid it back. And then if you run into that situation, there's a section on the 8915F where it talks about repayment specifically.
Okay.
And you would work from that point forward
Okay.
for those people.
Okay, perfect. Thank you. No, I had some clients that did take money out and they did not pay back. Then they were
Yeah.
just going to worry about it later. So I know that that's coming for 2022. And I just want to make sure that I was clear on it.
Yeah, you got it.
Thank you.
I have a question as well. I didn't see the 7202.
7202 is gone. That only applied for 2020.
I wanted to confirm. Thank you.
Yeah, the 8915 is the last bit of any COVID relief that we're going to see. Tax year 2022, by that point, all of the COVID stuff had been passed and was done. They felt no need to extend that stuff any further. I don't know if that's the right call, but that's the call they made.
Kevin, do you have that form on the software that you could give us a preview of what it looks like and what section needs to be filled out?
Which form?
The one that
The 8915F?
Yeah.
Sure.
Yeah, that'd be awesome if you can show us.
Let's go create a return. I don't have one. Let me just get through a couple of pieces here so we can add that form. So I found the easiest way is these checkboxes are sort of already here, right? So I go down and hit worksheets. And this is where you're going to need the information from their 2020 Form 8915E and the information from their 2021 8915F. Because all of this is relative to questions, right, that we can't possibly answer without those forms, right?
Would this
For
come
example,
over if it's a prior year client?
my understanding is yes, it should.
It should carry over. Okay.
Yes. Yeah, if you did it last year, it's going to be exactly the same way you did it last year, right? It's not going to be any different. So in this case, let's say we didn't do an IRA. We put in the taxable amount. So let's say the total was 30,000. And then where's it? Trying to remember. I don't think we have to do the full 30,000, but I have to remember. Yeah, and then there's stuff down here you got to do. There's supposed to be a FEMA number, but you get choices, and then because it wasn't just COVID, there were other disaster declarations that could be done. It was just COVID was the most popular one, and then you check that box to mark that it was for COVID, and then when I close, I think it should fill it all out. Now that's where we get into, there's a section. See this section, when we get into here in this worksheet, where'd it go? Go back up. Where's that line? Oh, it's right here. Geez. So if it was 30,000, then it's only 10,000 is what they're reporting this year. They're not going to report the full amount. They're just reporting what is taxable in the current year. And that's where you're getting that information from that 8915F. I think it's line 9 or line 20, depending on what type of plan it was. And that's it. So when it comes down here, it's going to tell them, hey, the amount that's subject to tax this year is 10,000. Like it's sort of that simple. It's not an overly complicated thing. And you'll see when I go over here right now, I have zero due because while that 10,000 is taxable, standard deduction clears it, so it's not taxable. But if I had income, let's say, it doesn't matter, I could put in 100, then I'm going to owe a pretty significant amount, when it comes down to it, right? And that's because this 10,000 is now taxable as income. I'm not paying a penalty on it, but I am going to pay whatever that tax rate is on it. So that's
where's the line? Where's the line where I show you how much you owe? I'm so small on my screen.
How much you owe?
Oh, right there. There it is. Okay.
Yeah, the line 24 is your total tax, and then when you get down to the bottom, it tells the amount that you owe.
Okay.
Now I have estimated tax penalty because I had all this money and whatever, but yeah, this is a little different when we're talking about the whole thing. Like I said, it's not any different than the way you guys handled it last year. That's the best I can tell you.
Okay.
Let me delete this because I don't want this returned in here. But does anybody have any more questions on the tax law changes or anything in that regard before we move into software?
I do. I just want to confirm that because I got kind of mixed up when you were going over the 1099K. Just to confirm, they're no longer sending that out, the 1099Ks based on an income higher than the 600. It's going back to the 20K.
That's correct.
Okay. All right. I just wanted to confirm that.
Yeah, that's what the IRS announced, that they were delaying that reporting. They're going to use this year as what did they call it? I believe the exact phrasing was something in the area of this is a transition year. What that actually means, who knows? I learned a long time ago not to try to understand what the IRS means when they say things and just take them at face value.
And does this apply? So, because I get a lot of clients that ask me if, like, for their personal accounts, they would be looking. So, like, for the 20K, regardless of if it's like a personal or a business account, it would still apply, or is it only for people that actually have like a business account?
Some of those companies don't have business accounts, right? Cash App, for example, didn't have business accounts, I think, until late this year. I think I just saw them release that recently. They're looking at the types of transactions it is, not what type of account it is. Because the reality is then, right, for me as a business person, I could just get a personal Cash App account and I don't have to pay taxes on any of my money.
Right.
No, that's not the way that's gonna shake out. I have a feeling we're gonna get a lot more pushback on this because of a lot of the situations that we have talked about, right? Well, what if I pay my employee through Cash App? They're gonna get 2 1099s? Technically, yes, because they're gonna get one from them and they're gonna get one from you. That's one of those things where it's like, I don't know how they're going to handle these things, and it's tough. And they're going to be looking, I think they're going to be using technology the best they can to try to identify this transaction. I understand why they're doing this because it's unfair. It puts an unfair balance on those people who do business the right way, report our transactions like we're supposed to. And I'll give you an example. We have a college student who cuts our grass here at the house, and we pay him $35 every 2 weeks or something like that to do it. Right. We're not the only house he does. I don't know if he's making 10, 20, $30,000, but I know everybody pays him through Cash App, and I am reasonably certain that he is probably not reporting that income on his taxes. Is that fair to those of us who report our income because we have to pay taxes on it, and him not pay taxes? And that's where the IRS started looking at this, going, okay. And let's be clear, it's not even the IRS who did this. This was passed as a part of the American Rescue Plan. This was Congress that said, hey, we gotta stop people from using these applications to avoid paying taxes. And the purpose of the 1099-K is more for those companies to report these transactions or these transaction amounts to the IRS than it is about reporting them to the taxpayer. The IRS wants to know. And the 1099-K is the easiest way for them to do it. These companies have to then report it, right? So thankfully, I think we've got a year or so where we're going to learn a lot more about this. I imagine this is going to be a very big topic over the summer when people start getting with the IRS, and the IRS goes back to their in-person tax forums, and they start hearing from us on the software end, from our banking partners, from you guys as tax preparers, and getting some different input. I am sure that this will be a very hot topic at those shows. So we'll know more when we know more is sort of the answer to that.
I know some of you kind of go through other platforms to get the continuing education and learn about different new laws for the year. Do you guys have any question, or if there's anything you want to share from anything that you have learned for this year? Hi, Kevin. I think we're good.
Awesome.
I think we have a question.
So do you guys want to take a break before we get into this? You just want to get into it?
I'm ready to keep going.
Ready, I can keep going too.
I think we should keep going.
All right, sounds good to me. I leave it up to you guys. I'm ready either way. Okay, so I know we've got some new people in here. I know we've got some old people in here. So you veterans, bear with us as we go through some of the things that you guys already know. We are going to do a refresher, if you will, on a full tax return, sort of start to finish, so that you guys understand everything in the tax return. But I am going to touch on a couple of things inside here, just quickly. When you log into the software, this is the first page you will come to. It is the work in progress summary. It is an overview of everything that is going on inside of the software. Everything from return statuses, your rejects on this side, as well as software updates. Okay. At the top, if you're doing business returns, then there's a tab for you to switch to business. I don't have business enabled on this. I don't need it. There's also a website tab. What is that?
Kevin, while you're covering that business return, when you get back, I know we have some questions. Some of you who did purchase the business software, in order for you to have it active, all you have to do is transmit. Just make sure you transmit and apply updates so that your business software could be released.
Yeah, if you've transmitted and applied updates and you're still not seeing the business tab, if you're not able to get to the business tab, and you purchased, reach out to support and we'll confirm. We may need to re-push the updates or something like that, but we can take care of it. So as we go in, you have a couple of places that you can start a return from. You can click add new right here, or you can go to lookup. You can type in the social here and then click add. However you want to do it, doesn't matter to us, as long as you get that return created. So when we first get in, this is the client data sheet. This is where you're going to get all your clients' pertinent information put in, date of birth, if I could type, names, contact information, occupations, things like that. I want to point out a couple things right here. One is this field right here where it says dependent. You would only mark this box if the taxpayer themselves can be claimed as the dependent of another. I have a general rule. If you're under the age of 21, I want you to call your mama and find out if she's going to claim you on her taxes. You live alone? Yeah, that's great. Call your mama. Call your mama. Let's find out if they're actually going to claim you on their taxes. Because the last thing that you want to do is file this return and then mom comes in going, why did you do this? So double check, confirm if you need to. Obviously, use your best judgment. Phone numbers.
Kevin, while you do that, I'm gonna jump in. I know we have a lot of people that are online. So this part is just for desktop only, because I know we already did the web-based software training on sometime last week. So if moving forward, Kevin, if there's anything else you're gonna cover other than desktop right now?
No, this is all software now.
Okay, so for those of you that switch or actually just signed up with the online software, you could log off if you don't want to see this. You're welcome to stay if you like, and we'll also be sending the recording in a few days.
Yeah, absolutely.
Go ahead, Kevin. And
So
Kevin, most of the people, so sorry. Most of the people, they are returning, so we could focus most of the time on the same thing we normally do every year to review the, what is it called? The mileage and depreciation. I think those are the questions we get the most. And any new forms that they need to get familiar with.
thankfully, we have no new forms this year.
Okay.
They finally got something right on that. It feels like. Okay. So let's go ads. We're going to go add some general forms. I want to start. We're going to add a W-2. You'll see this looks a little bit different. We tried to get these hard lines on here to separate these fields out a little bit better for you guys in the software this year, but didn't do a ton in terms of that. The software itself is not very much different than it's always been. Guys, it's really not. Just haven't been in a place where we've needed to make any kind of drastic changes to the software.
Kevin, have y'all updated the test cases on the website to reflect 2020?
You mean the tutorials that are on the website?
Right. Yeah.
Yes.
Cool.
Yeah, those have been updated. So if you want to use those, you absolutely can. They are already done. I need to go add a dependent. Okay. So now we have income on here. We've got our dependents. We're going to talk a little bit, sort of focus on the Schedule C, I think is where we end up with a lot of questions. So I want to kind of touch on mileage and actual expenses, as well as depreciation. Spend a little bit more time specifically in those, and then we'll show you how to wrap up this return in its entirety. Everything on the client data sheet is pretty self-explanatory, if I'm being honest. It's not an overly complex form. So when you have a taxpayer, they bring you their 1099 NEC, they might bring you a 1099K if they're doing credit card transactions, things of that nature. Your instinct is to add those forms first because you add a W-2, so you should just add a 1099 NEC. My advice to you is don't do that. You're going to double up work. You're going to have to bounce around a little bit more than you actually should. The easiest way is to add the schedule first. So you go add form, schedule C, you fill in the information that you need, and then you get into the business codes, and you can hit choices down here at the bottom to access that business code list. I'm picking one at random, it doesn't really matter. As we go down, we get down here into the income. And so if we click in this gray boxes are all calculated fields, right? So if we get into this gray box on part 1, line 1, we can go down and click form links. And then we can select which form we need to add, a 1099K, a 1099C, or a 1099 NEC. We're going to do an NEC. So we click OK, and then we're going to put in the payer's EIN. Whoever the payer is, because the payer could be an SSN, it doesn't necessarily have to be a business. And then obviously their address information as we go through. Then we get to the non-employee compensation, right? And the box underneath it is the most important link. And that is where you are going to report this income to. By and large part, the 1099 NEC is going to be reported to a Schedule C. Could be reported to a Schedule F if they got the money for working on a farm, or they have a farm or something of that nature, or to the 1040, but be sure that it is going to be reported to the 1040. Don't do that just to avoid self-employment tax. Okay, so we're going to go down here to the bottom. We're going to hit choices. Okay, you also can hit F3 on the keyboard and get to the same place. And then you want to select where it's going. We want to report this to our whatever Schedule C. So we're going to hit OK. And now when we go back to this Schedule C, you're going to see that we now have income in the amount of $15,000. So where we're going to focus on the expenses is line 9, which is car and truck expenses, and then line 13, which is depreciation. The rest of these are pretty much manual entry fields that you don't have to do anything more than just type in the amounts that are provided to you from whatever, balance sheet statements, whatever the case is. Now, for mileage, if you know that they are just going to take mileage, that they don't have any actual expenses, my advice is to come down into part 4 and check this box. If they have more than one vehicle, when you click in line 43 for the date placed in service, you can hit worksheets and you can add multiple vehicles. It'll take up to 3, I think. If they have more than 3, then you got to do it a different way, and we'll help you with that. Now, the date that the vehicle was placed in service is not 1/1 of the calendar year. Same thing on depreciation. When they ask for the date placed in service, they want the date that item, and in this case, this vehicle was used for business. So we're going to say 2/06/2019. And then this year, we have a split mileage rate. So January through June, the mileage rate is 58.5 cents per mile. July through December, it's 62.5 cents per mile. So your taxpayers are going to have to split up their mileage. They can't just give you a total yearly number. They're going to have to split it up. And it's what was done in the first half of the year and what was done in the second half of the year. They should be providing you evidence that is written, ideally monthly logbooks at minimum would be a good idea. So in this case, we're just going to put 500 before and let's do 400 after. We're not trying to do a ton. Total business miles, the commute miles, other miles. You technically should be putting in the commuting and other miles. I know a lot of us don't do it. Then you want to answer these questions. Was your vehicle available for off-duty hours? Did you have another vehicle for personal use? Do you have evidence to support your deduction? And is that evidence written? So you'll see now as we go back up here to line 9, that it has calculated the mileage rate for us. And that's what that mileage rate is on this particular return. So if they want to do actual expenses, I'm going to show you how to do that. That is done through the car and truck worksheet. So we're going to uncheck this just for the sake of doing this. We're going to go to add form. And we're going to go to, why is that not here? Weird. Thought you could get to it for ad form. You used to be able to.
Like from here, Kevin, from the left, you see the left side where you have document archive, remote signature, depreciation. Could I go?
Yeah.
from-
Yes, you can get to it from here
Uh-huh.
in the depreciation and go to the car and truck. You can also go to I think line 9. And I did this for a reason because I wanted you guys to see that if you go to this line 9 on the Schedule C, because this is a question I get a lot. Our instinct using this software, right, is to go form links or choices because we're used to doing that. If you go to line 9 and you hit form links, right here at the top, this is a print only page and it says, please enter all vehicle info via asset manager. And where you get to that asset manager and what they're talking about specifically is the car and truck worksheet. And that's right. If we go to depreciation, you can get to it from ad form depreciation, or you can go to depreciation on the left-hand side, and then you want to go to the car truck vehicle allocation. Now, this only applies for vehicles that you're going to do. You could do mileage in it. By and large part, this is where you're doing direct expenses versus mileage, right? So you're going to put in the description of the truck. Again, the date placed in service is going to be the date the vehicle is placed in service. That becomes increasingly important for depreciation. In this particular case, we're just going to select that one. We're going to hit OK. Now, you do have to put in cost basis. And so if we put in the cost basis here, let's say the cost basis, we bought this truck, it was $25,000. It's a pretty cheap truck. You're going to answer the questions. I never advised answering yes to forcing actual expenses or mileage rate. That's just my perception or my personal choice.
Can you tell us what it means, Kevin? I have some the difference.
Forcing actual expenses versus the standard mileage rate. One of the things that you could do is if you're not sure, and that's how I'm going to do this one. If you're not sure if they should take the mileage or the actual expenses, you can put them both in. And the software will give you whichever one is better, right? What you're asking it to do here is to force one or over the other.
I see.
So if you answer these questions no, and we go and put in the mileage like we have here and the actual expenses, when you answer yes to force actual expenses, it's only going to give us the actual expenses regardless of whether the mileage is higher. That's why I say no. And if you have someone who isn't sure about, if someone's got a pretty healthy amount of expenses, at that point, that's where I would put them both in using this method versus using part 4, right? If they think they want to take that, or they tell you, I think I want to take actual expenses, then plug them both in here. And then you can get which one is better. So for example, if I do total vehicle mileage for this year, let's say it's 1,500 miles. And down here, we do 750 and we do 750 here. Right, because that's where we're reporting the mileage on that vehicle to that activity or that schedule. And then down here, let's say I've got 150. I didn't have any vehicle rentals and I paid $87 in parking and tolls, right? When we hit yes or close on this, it's going to tell us, or it's going to show us on the form which one it gave us. We
Kevin,
also,
where it says total interest, is that would that be the interest you paid on the car payments?
yes. Yes. Total interest expense, total taxes as well for this vehicle, right? We've also added the depreciation piece into this. So it's there together. So you don't have to add the asset twice like we used to have to do back in the day. So keep that in mind that the depreciation is going to play into this too. So the depreciation on this vehicle is pretty good. So when we close this out, this is where we get into the special allowance. Special allowance allowed you to take the full amount of a property, basically. And we'll talk more about this specifically when we get to when we go into depreciation versus in this particular piece, because right now we're focused on mileage and expenses, right? So we'll go return list, we're going to hit close, we're going to go back to that schedule C. And what you're going to see is because the depreciation of that vehicle and the car and the actual expenses was greater than the standard mileage, that's what it gave us. If the standard mileage was greater, and we'll go back and change this just so you guys can see, we're going to go back into the car, truck, we're going to go back here, we're going to go here, and we're going to increase these miles to 50,000. And we're going to do 25,000 and 25,000. And I promise you at that rate, it's going to be higher, right, than the depreciation. So when we close this out, now you see the car and truck expenses is there at 32,000 and it wiped out the actual expenses and depreciation. So that's what I was saying earlier when we were talking about the software is intuitive enough to be able to tell you which one is better for you. Because the way it works is you can take mileage or you can take actual expenses and depreciation. You cannot take both, right? You can't take depreciation on the vehicle and the mileage on the vehicle. And the reason for that is that mileage rate is calculated. When that mileage rate is calculated, depreciation of the vehicle is included in that rate, along with maintenance and other things, right? In addition to just gas. So that's something to keep in mind there. So now we're going to go and add an actual asset for depreciation that's not a vehicle. We're going to go to depreciation. And we're going to click on that Schedule C. Now we're going to do new asset. And here's where you can put in any, you're going to put in the description and we're going to select the asset. I'm just going to do a laptop.
While you're doing that, I have a question. So
Okay.
let's say, I know a lot of my clients have this situation where you have small businesses, right, LLC, and they have multiple vehicles, especially truck drivers. Can you do one truck, just mileage, and then depreciate the second truck or so on?
Yes, it's by vehicle.
Okay.
Yeah, it's by vehicle. It's not by return or business.
Okay.
Because some vehicles you may only use part-time, right? And the depreciation on that vehicle and the actual expenses. For example, I'll give you an example. This actually happened to a friend of mine. They bought a new truck because the truck that they were using had the transmission break. Well, they didn't use that truck but a couple hundred miles, but replacing the transmission cost them $8,000.
Mhm.
So they were able to take the actual expenses and depreciation on that one, and they took the mileage on the other one because that one drove about 30,000 miles that year.
Mhm.
So yeah, it can be split that way.
And then one last thing that has to do with this. So, for what I understand too is that if someone buys a truck this year, they have to do the full depreciation only for the year where they bought the truck. They cannot do it later.
No, that's not true.
Okay, so if I bought a truck this year and I've been doing mileage, I could do the full depreciation in the third year?
No,
Okay, so how
no,
does
no,
that
no, no.
work? Can you go
No.
into that and explain that? When is the time where I could take full depreciation for a vehicle that I purchased for? Because what I hear is the year that you bought it.
Yes, but you don't have to.
No, that you have to, meaning
Right.
that if I wanted to do the full depreciation, I could only get the full depreciation on the year that I bought it, not later. That's what I'm saying. The full, not the part. Not the
Correct. Yeah, that's my understanding as well.
Okay, I wanted to make sure. Okay, and guys, I'm asking all these questions in order to kind of answer some of the questions that I've been hearing, but please jump in at any time for clarification or any additional questions that you have. Go ahead, Kevin.
Yeah. So we're just going to do a laptop for the sake of sort of making it easy. Again, that date placed in service, and this is where we're talking about specifically. If we left this at 1/1 of 2022, then the indication to the IRS is that we bought this laptop January 1st of 2022 for business. That is likely not to be true, right?
Mhm.
Secondarily to that, it affects these lines, the GDS, the AMT, the ADS, right? Because this is the amount of time that you can depreciate this asset. You cannot depreciate an asset forever. That's not how it works. there's a finite amount of time in which you can depreciate an asset, right? For example, a computer and a printer can be depreciated over 5 years. After 5 years, the IRS considers it fully depreciated and it can no longer be claimed. If you're putting 1/1 of the tax year every time you do this, then you're starting the clock over every single year. So that printer now may be 30 years old, and because we've been putting 1/1, it's never depreciated out, and the IRS comes back, audits that, and they like, wait, no. So now you've got to pay it back. So
Question to that. So let's say I do this client today, I mean this year, and they actually bought it in 2022, right?
sure.
I put it in. When they come next year, does the system automatically carry that over?
Yes.
And do I have to do it all over again, or it just automatically does it automatically? Or I guess my question is, do I have to go into the form and claim it again, or it just happen automatically?
No, it rolls over as long as it's something that can be claimed.
Okay, I don't have
As
to
long
do
as it hasn't depreciated out or it hasn't been sold or deleted, right? Then it will carry over. And I'll give you an example. Even if I put something in here, right, that is beyond, so let's say I do 0 to 2000, right? That's way beyond. It's not going to calculate the depreciation because
pass.
it's way past that time. That's why that date placed in service matters, because even if you don't know, if you're putting the right dates in, then you'll be fine.
And if I have done this, if this client I have done this last year, when I start his tax return this year, it'll give that deduction automatically.
Yeah, it'll carry it forward, assuming you didn't take the special depreciation the year before.
Right, the bonus one.
Right. If you take that special, if you're taking the special allowance, which allows us to take all of it in a single year, then you're not going to get it next year. Right? Because you already took it all. And that's where I was saying you have that option to take it, but you're not required to take all of it at one time. In fact, you can actually take it. If I remember right, you can actually split it. Like you can take 50% one year and 50% the next year if you want to do it that way. Or you don't have to take it at all. Right? That's entirely up to you. Sure.
So this is really just personal preference, correct? So there's no one recommendation over the other as to whether you should take all of the allowed depreciation or not, correct?
Right. It's
Okay.
all relative to what is most beneficial for your taxpayer, right?
For that year.
For that year. And that's the key. That's the key piece, right? So if I elect out, so let's say I've got this, I put it in, and this is where people will get in trouble. Watch. If I go over here, there's no depreciation calculating. The reason for that is because it's giving me the full amount. Even though I put it's 2019. Oh, well, actually, no, it's not because I didn't opt out. Let me go back to the Schedule C. What I needed to do was elect out of the special depreciation. The software is assuming that you had this asset in 2019, that you took the special allowance. So you have to opt out of it for it to qualify for depreciation because it was bought after 2017, right? 2017 was that cutoff line. So if you come in, and that's why I wanted to show you this. If you come in, right, I put this asset was purchased in 2019, right? The original cost basis. If you come in and that depreciation is blank like this, it's because the software is assuming that you have already taken it at the federal level, but you can still qualify for depreciation at the state level. They're assuming that you already took the special allowance. If they did not take the special allowance, that bonus, when this box pops up, check this box. It says, if you wish to elect out of this special depreciation allowance, that will calculate the depreciation correctly for them because they did not take it. And so now when we go back, you'll see now that 346 is there. That's where I think we saw some people missing opportunities last year, was they weren't checking that box. And then they were calling and going, well, I'm not getting depreciation. And it's like, well, no. And that's the question that you have to ask them when they come to you. Now, if it's a returning client, you know the answer to this, right? Or you should be able to look at the prior year and find the answer specifically, but it also will carry over. But if it's a new client, you want to ask them if they're bringing you an asset that they bought in 2018, did you take the special allowance? Look at a prior year return, because they can't just keep claiming that same asset. They don't get the special allowance and then get to depreciate it for 5 years or 8 years or 10 years, right? Like that's just not how it works. You can either get all of it up front or you get depreciation over the lifespan of that, over the time frame of that particular item, right? And this changes depending on what the item is. Certain assets go longer, for example. Land goes for 20 years. And technically it's land improvements, not land itself. Residential properties, 27 years. You know, you have others in here that are like 31 and 39 years. So it's all relative to sort of what that asset is. Will determine how long that asset can be depreciated. For example, computer software purchases can be, if they're purchasing QuickBooks for their business, they can write that off they can depreciate that software for 3 years. Or they can take all of it in 1 year. So for example, in my case, I'll go to furniture, right? And so you guys can see right here, right? We're already posting a negative 15,000. So looking at that, what would be the bonus in me taking a $15,000 depreciation on this asset? And the answer is there isn't one, because I'm already in the negative. It's already calculated. Now I'm down negative $30,000. I'm taking a loss. Does that really help me? Probably not. I would probably do better to opt out of the bonus depreciation and take a smaller loss so that I can carry that depreciation to the next year where maybe I have more income.
That's pretty good.
And that's the piece that you've just, as you're dealing inside these Schedule Cs, every client is going to be a little bit different. And that's the part that you guys are going to learn, is just sort of identifying what is most beneficial, right? Because look, and I'm doing this for a reason, right? My refund right now is $2,260. If I put $10,000 in advertising, my refund doesn't change, right? So if I have 15,000 in this depreciation, does that help me at all? And the answer is no, because I'm already taking a loss. My refund's not getting bigger. And in fact, in a lot of cases, it may actually hurt them when they go to buy a house, because they're showing an even bigger loss than they really need to be. So those are things that you guys are going to want to keep in mind as you're doing, as you get into depreciation, specifically with this special allowance stuff.
This is all like really great information. How soon can you post it on the website so I can slowly follow along and let it sink in?
This will be posted before Monday.
Cool. Is there also like an FAQ or something on all of this, or does it go over this in the software manual more in depth?
Probably not. And the reason for that is there's a very large gray area for what we're supposed to talk about and what we're not supposed to talk about. There's no hard line for it. And so for a lot of the developers, they choose to err on the side of caution and stay as far away from anything that could potentially be used to get them sued, if you will. It gets, like, even right now, we're sort of in that gray area. I'm comfortable in here, but it's just me.
Gotcha. So I'll create my own personal FAQ when I go back and slowly take notes from this.
Yeah, and look at, I would encourage all of you to look at the form instructions specifically for the 4562. When you get into depreciation, read through those, make sure that you're understanding what you see in there, because that depreciation can be an extremely valuable tool for your small business customers, but there are dangers to it. You do want to make sure that you're doing it the right way, because the last thing you want is 5 years from now to have that customer get audited and have throw a fit because you put something in maybe that you understood incorrectly. You know what I mean? So I encourage you all to look at that 4562.
Kevin, I have a question. I want you to go back to the date and then I want to share something after that. But go back to the date because I know you keep mentioning on the date. Well, we got to put the date. You know how you keep mentioning, make sure you put the date of use, how you saying it, the day that it was put to use? Or
Yeah, the day it was first used in business. That's
Okay.
not the day they bought it necessarily. It's the day they first used it for
Okay,
business.
to add that on there because again, I know we have new people that the date normally, is how you ask the clients the question to make sure they give you the right answer, right? So instead of saying when did you purchase that computer or when did you purchase that vehicle, it's more so when did you put the vehicle to use in your business. And also with that, Kevin, I have a question. So I know that the software also gives you the amount of depreciation based on how old the vehicle is, isn't it? Or is it based on the day that you put it in service?
It's the date it's placed in service. That's why they never ask, no matter what class I choose. Like if I go choose, let me watch. If I go change this to a vehicle, they don't ask you for the year of the vehicle.
It's the day you put it in
It's the
service.
day you put it in service. It doesn't matter. The year of the vehicle is irrelevant. You're able to depreciate what you paid for it, not necessarily what the vehicle may have been worth when it was brand new,
Mhm.
right? But what you paid for it. For example, if I buy, and this happens a lot with truck drivers, right? They don't buy brand new trucks. I don't know any truck driver that buys a 2022, Peterbilt. They're buying a 2004 Peterbilt, right? Well, that's a new asset for their business. The fact that it's a 2004 truck is irrelevant.
Mhm.
They paid what they paid for it. So if they paid, 35,000 for that truck, that's what can be depreciated. You're not necessarily depreciating the asset, if you will. You're depreciating your original cost.
Oh, okay. That's a great way to put it. And while we're on that subject, you see where it says 100%. And for those of you who have clients that do Uber, right? So, of course, they use the vehicle for personal use and for the business. So, what do you recommend on that area where it says 100%? Oh, I guess don't let's not say recommendation because we're in a great area. But can you
Yeah,
tell us how that works?
they've got to, for assets like that you're depreciating. It's
I would
how
say
much, you know what I mean? It's how much time are you using this? Do you use this for personal? And with a vehicle, it's a little bit easier than it is with other assets, right? Because in a vehicle, if you're doing it this way, and that's why I don't really do vehicles in the Schedule C specifically like that for things that drive, right? Bulldozers, things like that, that I will do in the Schedule C. The rest of them I'll put in here. And the reason for that is this. The mileage will determine.
Okay.
If you're putting that commute miles, which is technically other miles, I don't know why they list it sort of this way. So example, I have total vehicle miles. They didn't say total business miles. They said total miles. And if I'm putting in total commute miles, let's say I put in 15, let's say I do 10,000 here. Right? When we get into,
Yeah, that's a good one there. So you see,
total mileage entered is less than the business miles. See? And what they're saying is this is the total miles, but we have 1,000. And I want to raise it to 10,000. That means this can't be 25. It's got to be 20, right? Because the total mileage, this is the total business miles. It's not the total miles of the vehicle, right? Because the vehicle was used for off. And that's where I say that commuting miles is sort of where I put it. And that will affect your depreciation. That will also affect the oil and gas. And the reason for that is because it was used 80% for business. That's why I said I don't like the way this is worded, and I beg them to change it for years. It should say total other miles.
So it's not just the mileage it takes you to get to your place of
Yes, it's any miles that are used on that vehicle. So for example, if I put 100,000 miles on a vehicle in 1 year, and I took a road trip to California, that's not business miles. That's personal miles, right? If 20,000 miles of those are personal miles, then that means 80,000 miles of those are business, which means I should only get credit on the business side for 80,000 miles, not the full 100,000. And that isn't commuting miles, those are just other miles. But that's the way the law reads. And that's why I begged them. And me and one of their tax analysts have been begging with them about this for a while.
And I think to answer Joanna's question, one of the questions she asked is, hey, how do I know when to do the full depreciation and when it's not? And you gave a great answer. But just to tell you, like, as for me, the way that I determine that, I ask a lot of questions to the clients. And one of the time that I see them being benefit the most to take the full depreciation is when you know that they're trying to get either loans for their company or they trying to buy a house, because those are the time that you cannot put they cannot report too many expenses, right? Because it hurts their AGI. So when people are in that situation is when I take the full depreciation, because the full depreciation doesn't hurt the AGI for them to buy a house, but it helped them to owe less money, of course.
Right. Yeah. And that's the key piece. And that's what I was saying earlier when we're looking even at here, right, at this Schedule C, me taking that full depreciation doesn't benefit me this year.
Right. Well, already don't do it. Only if somebody owes a lot of money, but that they cannot put expenses because they're trying to purchase a home. That's the only time that I will do the full depreciation. Other than that, I'd rather do it over time, because you never know how the income may fluctuate. And they
Right.
really need it. They really need that expense the following year.
Well, I would give you an example. So like, let's say I put 40,000 in cash, right?
Mhm.
Now I've got a 17,000. So look at the difference here, right? My refund is now 25. Let's raise it even higher. Let's do 150,000.
Mhm.
Now I owe quite a bit, right?
Right.
And if I go back to this depreciation onto this $15,000 asset, right? And I take that special allowance. Yeah, I still owe a lot. I still owe a ton. That's because I'm over.
Yeah.
If I do 75, I think it'll take me over. I'm in a different tax bracket.
Right.
But if this is, let's say 2,500, right? I owe 11,000. If this is 15,000, I owe 8. That's a substantial difference, right? That's a $3,000 swing. And that's where I'm saying, if it's going to increase their refund or it's going to or decrease the balance due, then absolutely take it in its full. If they're already posting a negative, right? If this is 0, my refund's 2,260. If this is 2,500, well, that's different because of the way this is working. But generally speaking, right, if that doesn't change it, and in fact, in this case, I actually went up. If I put 15,000 here, my refund is lower.
Yeah, it hurts you.
Right, it hurts me. And that's where I'm saying, it's like, that's where you've got to look and pay closer attention. And it does that because now I have income, right? If this was, and I'll give you an example, if this was 5,000 versus 15, my refund would be the same. So it's not really helping me a ton either. Let's do 6,000. Right, 2,260. If this is, and I don't even care what this amount is in the depreciation. If I have 150,000 in the depreciation, my refund is still 2,260. It's not helping me at all. So if it's not going to help them at all this year, why take it? It may help them next year.
Right.
And that's the key piece. And that AGI, once they get to a negative AGI, there's absolutely no reason to claim that full depreciation, in my opinion, because it does not help them in any capacity, really.
Right.
They are much better off pushing that to multiple years.
Right. Or if they have enough expenses anyway to get the max refund, there's no need to do that full depreciation as well. Anybody has any questions? And because this is the area where we get the most questions throughout the year, because it's the hardest one to kind of remember the whole process, right? Any questions, anyone? Okay, Kevin, I noticed on line 9, I know we do control N to get to that form. You
Sure.
suggested to also just go to the link or no?
No, if you go form links, it's going to take you here.
Don't do that. So just do
Right.
control.
You can do control N, or you can go depreciation and go car truck, or you can do add form depreciation car truck. Either way, any of those 3 will work to get you where you need to. But yeah, you can go control N. You can do control N as well on the depreciation line, on line 13. We'll get you to the same place. So you got a variety of different ways that you can get to where you are.
Okay.
Let me go back to, I want to go back to that depreciation because I don't want to take it all.
On the where it was the date placed in service, oh, you went right to it. So if they have a car that's 10, 15 years old and they just start a business and put that car in that business, they can still say what they paid for it as the cost basis when they originally bought it.
Yes.
That's kind of okay. Interesting.
I mean,
Remember,
technically, yes.
and on the date, remember to put the day they put it in service, not when they bought it.
Right. Because if you put it when they bought it in the scenario that you're talking about, they're not going to get anything. Because that car would have been long depreciated if it was 15 years old.
Right, but they bought a car 15 years ago and paid 50. Let's say it's a real high end car, $50,000 for it or something, some real nice truck, and then they just started a business and put that in, in commission on their business. So they would say they placed it in service this year, but cost basis is 50,000.
That's where it gets a little tricky. And I say that because that isn't the cost basis for the business. That was the cost basis for personal. If that car was used for 15 years on their personal side, right, and then was placed in service and talk of business, then not necessarily, because that's the business. Now, if they bought a 15-year-old car for the business, then they put in whatever they paid for it, even if it was $50,000, even if they overpaid for it, right? But now you get into that hair splitting area, right, where they've owned this car for 15 years as a personal asset. To move it to a business asset, technically speaking, they need to sell it to the business for a cost, because that is a personal asset. Same thing with a house or property, right? If they bought a house and then turned it into an office, they don't get to put what the original cost basis was of the house technically. Could they? We're now, now we're in that super gray area. Technically, they shouldn't, is what I'll say. They shouldn't do it that way. And the reason for that is because that isn't the original cost basis for the business. That was the original cost basis for the person. And those are 2 different things. Does that make sense?
Kind of. I'm just thinking of all these people, so many people these days that do things like DoorDash or work on the side for Amazon. And, they've had their personal car for a long time, but all of a sudden now it's their business vehicle. They're using it that way. So selling it to their business on that, I'm sure no one has actually done that, but
no, yeah. But the likelihood is somebody in an Uber situation like that, they're probably better taking the mileage.
Yeah.
Unless they had some kind of major, replacement, new transmission, had to put a new motor in it. You know what I mean? Something that's just a crazy expense, because the mileage rate is so high. I mean, they're getting 62 cents a mile for the second half of 2022. As an Uber driver, that's almost unbelievable for it to be that rate. I mean, 52 cents a mile is tough. That's a heavy rate too. And then when you get up to 62 and 58, their gas, and that's the key point. That's why they do the standard mileage, to make it easier for people, so they don't have to try to figure out depreciation and then all the expenses that go with it. So those things are that's sort of why it is that way.
But Kevin, this is Joanna again. I follow your logic, but the same thing would apply with your example of a computer, right? So if I have my laptop, you know, I bought, I don't know, 2 years ago, and this year I'm with you guys, would the same logic then apply to this asset if I wanted to depreciate it for the business, since technically I'm using it as of today to do taxes? Does that make sense?
Yes. Technically, yes. That logic would apply to all assets, right? No matter
It
what the
would.
asset is.
Okay, okay,
That technically, yes. And
Okay.
that's the key. That's sort of the
Okay.
key component to it. And that's why they say original cost or basis, right?
Mhm.
It's not just the original cost. Because in
Okay.
those scenarios where you're adding assets that have already been purchased,
Uh-huh.
right, then you're looking for what the cost basis or what the original basis is. And that's why I was telling you guys, go take a look at the instructions for the 4562 and the
Okay.
depreciation specifically, because they give a
Mhm.
better description than I'm probably giving right now. But that is my, and again, I want you guys to take all of everything that I'm saying here with a grain of salt to a degree, because this is my understanding of it,
Right.
right? And
Yeah.
that's one of the things with tax law. And Anna can tell you a lot of this stuff is subjective.
Mhm.
Anna and I have gone head to head on some things over the years because
Right.
I understand it one way, she understands it that a different way, and that doesn't mean that either one of us is right, and it doesn't mean that either one of us is wrong. Right? Both of us could be right, and both of us could be wrong. It's the tax code is complicated on purpose, and for us as business owners in this industry, we should be slightly grateful it is, because if the tax code was super easy, they wouldn't need us. Like that's sort of the catch in the whole thing. People come to tax preparers because they are scared to face the IRS alone. They are afraid they will make a mistake. Like that's the number one reason. And then the second reason is because they don't understand and they don't want to miss out on something. Right? So we took a massive loss on our business because we drove a bunch of miles here. So I think we're done, right? So let's go verify and let's clear everything out that's here. I have a ton of verification errors. So one of the things I want to show you is when you verify, to start clearing out these verify errors, you can hit enter. It will take you where you need to go. And then when you hit enter again, it'll take you right back to the verification window. So in this case, I am going to do a bank product, but we'll get to it. I must check yes or no. No, we didn't sell any digital assets. Why does it say? No, it doesn't like the social. I'm missing a required field here. Qualified. So as we go through, so now we get to the EIC checklist. And the EIC checklist is just a couple of things. There's just two questions really here. One is line 10, and it says, is either of the following true? The child is unmarried. If the child is 6 years old, stop right there and answer yes. They're not married. That's it. If the child is unmarried, answer the question yes. If they are married, then you have to continue reading further. The next one is, could any other person claim, check yes on lines 9, 10, 11. Basically, could anyone else claim this dependent for EIC? I'm going to say no, but I got to be honest, in a head of household situation, that answer is probably yes in a lot of cases. And at that point, you want to indicate as such. Now we get to the 8867. 8867 is paid prepared due diligence requirements. These are questions that you are answering on behalf of yourself. They're not questions that you are asking the taxpayer. I cannot go through every one of these questions, so we're going to fly through, but I'm telling you that you want to make sure you read these questions and you answer these questions as appropriately and with the best information you can provide. Come on. I'm moving faster than my.
Kevin, while you're in this area with the earned income credit and stuff like that, so I might plan you one scenario. I don't know if you may know the answer to this. 'Cause I know at least two people I got a call last year where you have the spouse, one is claiming the earned income credit and the other one is claiming just the child tax credit. I think I kind of know where to go to put the child tax credit when it's the spouse only claiming that. But is there a place where you could out that you got to mark to reject the child tax credit? So if I do the taxes for the person that's only claiming the earned income credit, do I need to press anything on the software so that the husband don't have, or the ex-husband don't have any trouble claiming the child tax credit?
Okay, so whoever's claiming child tax credit has to claim the dependent. That's the
Right.
rule, right?
Right. Those
In
are-
the EIC, they can claim them even if they are non-dependents.
okay,
And
so
that's where you go down into the bottom section here and you would enter non-dependents claim for EIC. And they
that's-
would fill this out. They would not go up here because they are not their dependent.
Okay, so the bottom part is the parents who who claim the child, but it's not their dependent.
The bottom is for anyone claiming EIC for someone they are not claiming as a dependent,
Okay.
right?
Mhm.
To claim child tax credit, they have to be claimed as a dependent. So if one parent is getting child tax credit, that parent is claiming them as a dependent.
That goes
The
up to-
other one is not.
Okay.
That's
And-
the split, and that's why we have this split here, and that's why it says non-dependents claim for EIC, because they can only claim them for EIC. They cannot claim them for child tax credit in this scenario, right? And that's why child tax credit, that line doesn't even exist here.
And when the parents who's claiming the top part, right? Do I need to put anything in anywhere in the software so when the second parent come, it doesn't reject it?
Yeah, they need to. Well, it's not so much. I don't think it's necessarily going to reject it, but you don't want them both claiming EIC on the same
Right.
dependent. So
Right.
in that case, they would need to come in and change this to N for none because they don't qualify for EIC on that dependent.
I see. So
That
that's
dependent can still be claimed for EIC, just not on this tax return.
right. So everybody got that, and that was the one where we were struggling because the other parent was getting rejected, but it was when they did the first parent, they didn't put the N there, and they didn't know where in the software they need to mark to address that they were not trying to get the EIC for that child.
Yeah, that's it.
Anybody have questions on that? Okay, I think we're good, Kevin.
All right. Well, I mean, we're not now. Now I got to go back and answer all our questions again. Okay, now it's telling me to print the bank docs, which I don't want to do. So we're going to go to the next one. Okay, so now we get down into, now we're on the bank application itself. And I'm just going to kind of quickly go through these things. Oh, actually, I can transfer it from the client data sheet, can't I? Or did I not? I didn't. If you enter the ID information up here in the client data sheet, it will carry forward. I recommend you do this because you're technically supposed to be verifying their identity, and having that ID information in here on every return proves that you did. They gave you a physical ID, right? So it makes it a little bit easier. Choices, driver's license. You want to check this box that says you have examined it. Oh, it's a yes or no. Sorry. Then we get into this section here where we start talking about the fast cash advance, as well as just sort of standard bank products. Now, on here, if they want a fast cash advance, you're going to check this first box. IFIN's not approved for it. So you're going to want to check this box here on the fast cash advance, and then you're going to want to check the box underneath it for the pre-ac if they are getting a pre-ac advance. Okay. If they are getting just the standard fast cash advance, which means it's post-ac, meaning the IRS approves the return or accepts the return, and then the bank gives them money, then you just check that top box. If they want to get it before the IRS has accepted the return, then you check the second box. Then you enter the communication preference, whether they want to be notified via email or SMS, text. Down here is where we get a little tricky. You want to pay attention to this account information section because this is how your taxpayer is going to get the money, right? They're either going to get a cashier's check or direct deposit. And if it's direct deposit, then you can get that information here, right? And you're going to enter that information. The go-to bank card for those of you that are using TPG, between all of us here, I don't recommend using them. It creates more work for you. If your client really has to do it, then obviously accommodate the client. But by and large part, I think I saw less than 100 of them used last year total. So there's that. Then it gets down into the fees. And down here in this fast cash advance, this is the part that was getting some people in trouble last year. That is an estimate. That is not the amount that they are guaranteed. The fast cash advance is roughly an estimate on what they might get if they get it. Don't tell people that's what they're going to get. It'll go to the bank. The bank will approve or deny it. I will tell you this, there's nothing that you can do in the return that will change the status of their approval or denial. Meaning nothing you do in the return has any impact at all on whether or not the lender approves them for an advance or denies them for an advance. It has nothing to do with you. It has to do with what qualifications this taxpayer has in terms of the lender and the information that's physically, for this return. As long as you do the return correctly, nothing else is on you. So once we've done all of that, what am I missing here? Oh, I'm going to clear out some of these verifiers. Yeah, I did that. Let's do that. Good. Citizenship status. Okay. So now we get to the last one that says print bank documents before transmitting the return. You can do that a couple of ways. It's up to you. You can do print bank documents, or you can do final tax return. And if we do final tax return, this message pops up, click next, and you want to make sure that it says print final return with bank documents here, right? And then we print. And now you have the option to print, or you can do a signed doc. If you're using a signature pad, you can send a remote signature. I'm going to point something out on the remote signature real quick. If I can, I may have broke the software. Okay, come on. My Adobe printer is very slow. Okay, when you do remote sign, sheesh. Okay, so if we go print final tax return, next. Oh. After you print it the first time, right, which I did, you want to make sure that it says that the taxpayer has reviewed and signed all the documents. You want to answer that question, yes. You do not want to answer that before you print it or before they have signed. Now, when you go to remote sign, I just want to point this out. You do want to make sure that you opt in, and you likely want to make sure that you charge this. This is one of the things that causes this verification to come back. Because if you answered this question yes, you've now changed the fee amount on the bank application. That is going to prompt you to need to reprint it or give you the message that it needs to be reprinted. I did it specifically this way because I know we had a couple people last year that kept doing this and they kept calling because I have already printed the bank documents. technically you did, but if you make any change to that bank document, the bank requires it to be reprinted and re-signed. So we're going to go back, we do print final tax return. And this time we're going to click remote sign. And I'm pointing this out because you do need to have a wallet set up for that option. If you haven't set up the wallet, you want to make sure that you go in and set up the wallet, add new card, update the email address first. And then you want to add new card in here at that point, fill in the information. I'm not going to do this because I don't want them charging me for anything, but I want to make sure that you do that. Now, when you click remote sign after you have the wallet set up, there's going to be a window that pops up. And that first window that pops up is for anyone who needs to sign on the signature pad in the office. My advice to you is leave that box completely unchecked, then hit OK, and it will give you the remote signature options. Okay. Once you've printed everything that you need to print, which I didn't. All right, fine. Go away. Then you can queue the return, and you're just going to click queue. You're going to make sure that it's selected here, hit queue. And when you come back out, transmit, and that's it. It's gone. Now, keep in mind that we are in the pre-season mode right now in the software, meaning you can transmit returns to the filing center, and we will hold them until the IRS opens, whether it's hub testing, which I still don't have a hub testing start date. I'm thinking it will be towards the end of next week, or when they open up fully, which again, we don't have an official date. My experience tells me that it's likely between the 23rd and 26th, but we don't have an official date. I do want to caution you about transmitting any returns that do not need to be transmitted. If they're getting a pre-ac advance, transmit the return, because if you don't, they can't get the pre-ac advance. Any other return, I would wait. I would wait until the IRS opens officially, or at least until hub testing has started. The reason for that is because if that customer comes back in a week and says they have another W-2, we cannot pull the return out of the filing center. Once it is gone, which means you will have to wait until the IRS responds to it with either an accepted status or a rejected status. So that's my last little bit of caution. Anna, do you have anything else? Does anybody have any questions?
I am good. Anyone else has questions? Oh, well, do you know, you probably don't, but I asked anyway, approximate date for first day of filing?
I'm sorry, say that again?
Do you know when it's going to be the first day to file?
No.
Yeah, figure that. Do you know if we're going to be really, really late? We're not.
Hub testing will tell us everything, but my like I said earlier, my experience is indicating my best guess is somewhere between the 23rd and 26th. But the IRS has stopped giving out that date prior to hub testing because we broke the system in 2016, and then we started like 6 weeks late. And we started like 3 weeks later than the IRS had told everyone we were starting, and they never want to do that again. So they have stopped giving out that date.
So Kevin, can we transmit though, like, I guess it's for all returns, then that would include prior year returns. So if I have somebody coming in with prior year, it'll be the same scenario, correct?
Yes, the
Okay.
IRS is currently not accepting any returns at all. They will start accepting business returns on the 12th, I believe. But the business system is a whole lot easier to deal with than the 1040.
Gotcha, thank you.
Well, if no one else have any questions, we're going to end this section, and let us know. Give us a call. That our number is on the chat if you have any question other than it has to do anything that don't have to do with the training. Thank you, everyone.
Yeah, you guys have a great day.
I'm sorry. One last quick question about the app. Is there somewhere we can go get information on that online?
Actually, I'm glad kind of that you brought that up because there is no app anymore. What they did is they went to a mobile website. And if I'm being honest, we weren't told. I hate to say it that way. I found out because someone told us. We weren't told. The developer did not tell us. But if you go into the same place that you did your bank enrollment, you should have an option under support for mobile site management. And it will give you a link, essentially. So the link, and let me see if I can.
Or it's not that tax pass that was on there previously to download?
No. They go to, hang on, I'm going to share my screen again. They go to taxpassapp.com, but you need to give them your link, right? Like this link that you guys see is for one of our offices. I just pulled it up randomly. And it is essentially the app in a website-based format, but it is designed to be used on a phone. So if I was to like log in or register, everything stays right in the middle. Like it's not a real, I hate to say it's not desktop friendly as a user. It's designed as a mobile website essentially. And that's why I said, if you go into the, let me see, I'm not sure I can even log into it from here, but we'll try it. Desktop software. You log into the customer portal here. Let me see if it'll let me log in. I think, okay. Oh, good. I haven't logged in a while. Under support mobile site management, they give you the QR code, but they're supposed to be giving us the link. And I don't know why this hasn't been updated. So like I said, we just found out about this last night when someone brought it to our attention. We generally don't mess in that mobile app a whole lot. So I will have more information for you guys about that coming out in the hopefully by Monday. We have to get with the developers. If I'm being completely honest, I have no idea what they did or why.
Okay, because I love the idea of like being able to, if we're mobile or something like I do a lot, to be able to scan through the app and it automatically go into the files, in the software. That would be.
Well, the whether it was the mobile app or the mobile site, which is what it is now, that's all designed for your taxpayers to do everything for you. So for you virtual people in particular, that's something I would be promoting because they can literally do 80% of the tax return work for you. And then you can fill it out the rest of the way. But like I said, we just found out that they discontinued the TaxPass app last night. I have not even had a chance to get my head wrapped around it yet.
Kevin, you think maybe down the road, I don't know how busy we're gonna be, we could do a short video on how to set that up?
Yeah, as soon as I figure out how to set it up.
You do a screen
Yeah,
recording?
I'll put together a video before we send out anything anyway. But right now, Chris and I have to get our hands around it because like I said, we didn't know.
Yeah, right. It's all new. So you
Send
guys,
me an email if you need a guinea pig. I do systems analyst work for my day job.
Oh, nice.
yeah, pretty cool. So what we'll do is once we figure this change, we'll go ahead and do a little screen recording to show you how to take advantage of this change, and then we'll take it from there.
Yeah, absolutely.
Okay. All right, you guys. Thank you again. For those of you that are still left in here, if no one else has question, we're going to end this section. Thank you so much. Have a
Thank
good
you.
All right, you
Thanks,
guys have a great day.
Thank you,
Thank
Anna.
you, Kevin.
Bye-bye.
Thank you, guys. Bye.